Well. Here we are. Wealth on Wednesday. Glad to be back. We're talking about some things that you can do at the end of the year, right? Some smart money moves you can do at the end of the year for tax purposes. For tax purposes. Let me say this. This is not to substitute any information or consultation that you could get from a tax professional. These are just ideas that you need to explore further, right, in order to advance in your investment journey. These are just some ideas that you need to explore further in order to advance your investment journey. Your journey is going to be a very individualized journey because your situation is your situation. Your tax situation, your financial situation, your overall financial picture is going to be different than everyone else in a general sense. And so there's going to be some specifics that you want to take care of for you that may require you to speak to a tax professional. That's all I'm saying. And so thinking about that, we're talking about end of the year money moves for tax purposes. And let me get into this because one of the things that we want to start out with is boom, tax harvesting. Tax harvesting is one of the things that we look at when we talk about investments as far as tax loss harvesting. And so that begins with tax planning. As an investor, whether you're just investing for retirement or you're investing in both taxable and tax-free accounts, I want you to understand that your investing needs to include tax planning. Because if you're not including tax planning in your investments, you can pay a heavy cost going into the next year. And so your investing should include some form of tax planning. How do we handle that? How do we make that something that we can manage? Let's talk about asset placement. For instance, where you place your assets are going to make a difference in your taxable situation. If you place assets such as master limited partnerships and REITs in your taxable account, you're going to have a different tax experience than someone who's using other tax savvy strategies for their asset placement. So consider where you place your assets and what type of tax implications that could include. For instance, you've got assets that are going into a taxable account that have a higher taxable rate, or those assets generate greater capital gains. You want to make sure that you're looking at that and you're aware of, okay, these funds, if they operate as expected, could generate a taxable event for me that increases my tax liability later on. That's what you want to look at for asset placement. And so where you place your assets matter. What type of assets you place in different types of accounts. Your retirement account, for instance, your Roth IRA may be a great holding place for assets that generate larger taxable occurrences. And so your other assets you may want to hold in a taxable account. And then you have assets that you want to hold, such as I bonds, that are to protect you and leverage you from the issues that are related to inflation, but those you may want to place in a retirement account because of the taxable benefit that you have long term with I bonds. So think about your assets, the source of their income, and the type of growth that they may have. Do they generate capital gains if you're investing in mutual funds, for instance, and where you have those placed? Taxes, expense ratios, all those come into play. And then think about your asset allocation. Where do you have the assets, and then how much of those assets is part of your portfolio, because you may have assets that generate capital gains, but then you may have other assets that offset that are strictly growth and may dominate a greater portion of your portfolio. For instance, stocks that you don't cash out, whether they go up or down, those don't impact you tax-wise. It doesn't impact you until you have a taxable event, such as a sale or a distribution. And so those type of asset allocations help you with your portfolio growth long term, as well as your portfolio sustainability as far as rebalancing based upon your transactions. Trying to make that simple for you and trying to make it to where you can understand. So let's get into tax loss harvesting, because that's a big one that we tend to look at and not necessarily have a complete understanding of it, but we want to look at it and look at it from another perspective, right? And so these are just coming from AI generated searches that give an explanation of tax harvesting and part of the process. And within that, tax harvesting deals with you have an asset that's at a loss, you sell that asset, and you're going to use that sale of that asset to offset capital gains, distributions that you've received from other assets that are in your entire portfolio. So think about it like this. You have specific assets that you have, but then they all work together in your tax plan picture. For instance, you may have an asset that you've invested in that suffered a loss, and right now you could think about, okay, I'm going to sell that. And so number one, you identify that asset, you look at it, and this works in taxable accounts. Remember, works in taxable accounts. And so it's decreased in value from where you bought it. Now, to realize that loss, you have to sell that asset. You have to sell it back into the market. Once you've realized that capital loss, right, you can use it to offset capital gains. Now, keep in mind, this is going to reduce or eliminate taxes that you owe on gains, right? Gains from other investments within the same year. Check out the deduction. If your capital losses exceed your capital gains, you can use up to $3,000 of the excess loss to reduce your ordinary income. Imagine that for that tax year. And it's $1,500 if you're married filing separately. Okay? Now, here goes the big deal. Dog got a little wild. Give me 1 second. And so your taxable events, right, are about offsetting your losses. And those offsetting actions, right, can reduce your ordinary income, as I said. And it works differently depending on how you file. But keep in mind, these are to your benefit when you're operating and going through what you have that have generated income, what you have that have generated losses, also those that have generated capital gains. Now, you can carry forward losses, right? Anything that's beyond that $3,000 limit, you can carry forward indefinitely to offset capital gains or income in future years. And here's why I say definitely consult a tax professional, because you, as an individual, you may have trouble keeping track of those losses and carrying it over from year to year. but as you speak with a tax professional, that may help you deal with those tax losses that you have. Hope that helps somebody right there. Here goes another part. Here's some things to consider. Tax loss harvesting mainly applies to taxable accounts, right? You're not going to be taxed for 401ks or IRAs, those types of tax advantage accounts. So you're mainly looking at your taxable brokerage accounts. You've got short-term versus long-term losses. Your short-term losses are, those that you experience for 1 year or less, and those are typically offsetting your short-term gains. Then you have your long-term losses that you can use against your long-term gains. So if you've had a fund that you cash in order to offset paying for, child care all of a sudden, or an unexpected medical expense or car expense, those will be long-term gains. And so I would offset that with something that would be a long-term loss. Apples for apples, oranges for oranges, right? We don't want to mix the two. Now, here's the thing. It really benefits those with higher tax brackets because they get a greater tax savings. And those that are in different tax brackets, it's going to be basic. And it's going to be something that you really need to look at and test and see, is it worth it? View it, look at it and see. And one of the things is, because of this period of the calendar year, the timing is of issue. The timing is the thing that's at issue. And so now we're going into December. Now's the time to start looking at where might you realize losses for the year and take care of those before December 31st. Otherwise, it's applied to the next year. And so you have time now. Talk to a tax professional, consult them, a financial advisor who's familiar with tax loss harvesting, and see how you can maintain compliance and maximize your benefits. Does that help somebody? I hope that helps somebody out here, because that's what we're trying to do, and that makes a difference. And so, boom, let's think about it like this. You've got tax loss harvesting on one side, and then you have your IRA contributions on another side. Now, here's the thing that's the beauty that goes beyond the end of the year with IRA contributions. Your IRA contributions for this year can continue through 2026. You're good until April 2026. You're good, right? And you're good until April 2026. And that's going to make it to where you can have plenty of time to catch up and add to those contributions. Is that strictly for IRAs? Well, look at it. How do you invest in your 401k? And in most cases, you're going to change and adjust your 401k based upon what you're able to take from your wages and what's matched by your employer. So the IRA has the best advantage of allowing you to continue to make contributions through and into the next year. The Roth IRA, if you're doing a Roth conversion, things of that nature, you need to look at those and see what's to your maximum tax benefit right now. While everyone else is jumping on board and trying to find Black Friday sales, you need to be talking to a tax consultant or a financial professional who's really familiar with tax benefits and see how can you maximize this strategy in order to hit the numbers that you want, in order to make the contributions that you want for your IRA. I personally carry my IRA contributions through April and then spread them out over that period of time. It works, and I just have to say, there's not a lot of stress at the end of the year with the IRA contributions as much as it is in the middle of the tax season. So it just comes out to a different balance. The limits are the limits. So your limits of contributions are your limitations. And some of that deals with age and some of that deals with income. And so be sure to remember that your taxable contributions are going to be carried through, right? Not your IRA contributions can be carried through April of 2026, but that's just one benefit you have with the tax code. Hope everybody gets that. Hope everybody understands it. Let's move on. Finally, donations and gifts. We tend to not look at this a lot until the end of the year, but not only do we have Black Friday coming up, but then we also have Giving Tuesday, which is a great time when nonprofits can benefit and they can get a piece of contributions that people are trying to make before the end of the year, and people who don't have charity identified can find out more about charities that are available and things of that nature. I think this is a great time because this is the giving season. Anything that follows Thanksgiving into the end of the year tends to be the giving season because corporations are trying to get their write-offs. Individuals are trying to get their write-offs. If you come into some money, you're trying to get your write-offs and say, who can I bless in the meantime in order to reduce these taxes? If you're tax savvy and realize you've made some gains, that's a great way to get some write-offs. Make a contribution to a notable and worthy cause. Do something that'll be a donation towards doing good. Make it happen. You need to have it done and distributed before December 31st, right? Gifts, right? Are you giving gifts to family, friends, anything of that nature? Do it now before Christmas, before the end of the year, in order to maximize those benefits on a taxable side. And I say, do that if you're giving a significant gift to someone, do that in the manner of a cashier's check, bank draft, credit union check, whatever it may be. Don't simply give people cash. A personal check, you can still track it, but the issue is, okay, did you mail it? Did you do all? How did you make that contribution? Where here it is, you make that draft, you make that deposit, it's given to the people, they've got it, and whether they cash it before or into the end of the year, it doesn't matter. You've already made the contribution. You've already made the gift available to them, and it works out to your benefit. So look at Giving Tuesday. Look at family, friends that you may gift and help out, adopt a family, whatever it may be. But you want to take advantage of this tax season. You want to take advantage of these moves that you can make within your taxable accounts as well as your personal finances and make it happen before the end of the year. God bless.